Okay, good morning, everybody, and welcome to the Daily Energy Markets podcast. It is Tuesday, February the 7th, 10:30 UAE time. And before I start, I just want to offer from our small little corner in the world condolences to all those in Turkey and Syria facing a very, very tragic circumstances over the last 24 hours with the terrible earthquake there. Clearly a very devastating event still playing out by the hour. So condolences to everybody under that problem. Kick off this morning, we see oil prices bouncing after that dip below 80 on Friday on Brent. They're climbing back out of that hole with some optimism. It looks to me like some of the actors, the big players, are kind of bolstering that market up. We had the Saudi energy minister over the weekend is signaling a shortage, and here we are Monday with Saudi Arabia raising its OSPs to Asia for the first time in 6 months. Kate Durian, Meese contributing editor and non-resident fellow at the Arab Gulf States Institute in Washington. How do you interpret the Saudi raise of Asian OSPs, as stated, first time in 6 months?
Well, I suppose it's on signs of demand growth in China. That's their big market. I think that's probably one of the main reasons. I don't think India is going to be very happy with it, but then of course they're buying very heavily discounted Russian crude. I mean, we keep talking about crude oil, but the big story at the weekend was the price cap on products and the embargo on refined products. Russian refined products came into effect, and that's going to change flows again. So I think we're not going to see just a change in the direction of crude oil flows to Asia, but also diesel, gasoline, and so on, both from the Middle East and from Russia. So I think that's really where the market is at the moment, because it's certainly not Europe.
Peter McGuire, CEO of XM Australia. We were talking yesterday a little bit like maybe the market had really not had got it wrong in a sense that the China recovery wasn't going to be as sizable as it could be, and hence the prices below 80 didn't reflect that potential demand surge was just around the corner. Your thoughts on that outlook, or is it still premature to say China's back?
Well, maybe a little bit. And good afternoon, Sean. Greetings from Sydney and to fellow panelists and to everyone. And our hearts are out to everyone in Turkey and Syria. A lot of those people are blessed and they live in Australia. Where we go from here, Sean, yes, it's only a slow time back. I've noticed that Chinese equities have had a nice bounce and they're doing okay. It's a mixed bag today, but certainly last week was quite strong, and some of those days across Hong Kong as well. US, I think we waited to see Jay Powell's rhetoric. We understand what happened on Friday with that non-farm payrolls at 517,000, estimate of 185, and they're out by 200% on the forecast. So it's very, very strong numbers. And Eurozone and England raising rates 50 basis points. We knocked it up 25 today. So I don't necessarily think that we're out of the woods as far as rate hikes. But the other side is, Sean, that US dollar has been so volatile, and that's really the storyline. Gold lost 100 or 20 odd dollars. It's made a little bit of reground, but crude it's been just a marvelous trade. If you look at it from, the last 4 weeks, crude has been just so energetic. The traders are rubbing their hands with glee on the retail side because it's been long and it's had very big lick ups, and then all of a sudden lost $10. And I think that we're just in that consolidation phase and we're trending up again, Sean.
Omar Ubaidli, good morning to you, Director of Research at the Bahrain Center for Strategic International and Energy Studies. Perhaps, Omar, the Saudi Energy Minister, Prince Abdulaziz bin Salman, who's actually in India, I believe, this week, has some insight on, as he indicated over the weekend, that shortages could be coming from all these sanctions. And so tightness into Asia might be earlier in the year than the market had forecast, seeing it's in the second half of the year. It could come earlier. Your thoughts?
Well, first of all, I mean, I have to acknowledge that Saudi's oil ministry for a long time has been, a consistent source of technocratic expertise, and is very much more well motivated and incentivized to analyze the situation than the sort of screeching that goes on in, Western newspapers and Congress and so on. And yes, I would say that his assessments, if you look at his, the predictions he's been making for the last 3 years since he's had the job, they've generally speaking been on the money. And the most salient one of late was the one made in, I think it was June or July, when they're talking about the output cut, which went more or less exactly as planned and came in. So I would take what he's saying very, very seriously. I also think that, Saudi Arabia's diplomacy, foreign policy has become a lot more aligned with its oil policy than in the past. And as a consequence, this affords the Saudi oil minister further insights into what other countries are thinking and what they're doing than would have been in the previous case. So I'd absolutely take his words very seriously, and I would definitely steer clear of what Western states people are ranting about when it comes to these markets.
And having taken him very seriously, what do you think about what he took very seriously?
So I think that shortages, I think there is a definite fear of shortages. I think that also everyone's seeing what is happening at the border in Ukraine, Russia now, and I think we're getting ready for potentially a very big military escalation, probably two-sided military escalation. And I think it's inevitable that will have an impact on supply chains, whether they're broader supply chains or ones linked to oil. I think we should expect more sanctions, more severe diplomatic action against Russia in the coming weeks, and surely that will be reflected in oil markets. So I assume that's what he's getting at, tacitly at least.
Kate, you mentioned in your earlier comment there the outcome of the new embargo, the EU embargo on oil products coming out of Russia that came into effect on Monday, on the 5th, or Sunday rather, and that's 2 months after the crude oil embargo came into effect on the 5th of December. Your thoughts on the impact on these things? I mean, the oil markets seem to be a little bit yawning on the consequence, or the sort of the torpedo or the intention of these embargoes. Have they had an impact? Will this one have one?
Well, I mean, it's had an impact in that it's kept flows going. That was the whole purpose of it, is that not to stop the flows of crude oil and refined products, but to actually make sure that Russia doesn't get the full benefit from in terms of revenues, which they're not. But they are shipping more, shadow tankers moving, the ones that were shipping sanctioned Iranian oil and are going to Russia. They are getting insurance because at the end of the day, they were already offering their crude at below the price cap. And that price cap can be, retuned, even though it's a sort of fixed price. But again, on demand side, I think the first quarter we're not going to see that much demand growth. It's a second quarter which is going to be a problem, which is why I suppose if you look at the forward, we're talking March now. If you talk about the Saudi price, the official selling price is for March loading. So we're already heading into the sort of second quarter where we expect demand to sort of pick up. But again, as I said, the war is, it gets to a point where unless there is a major escalation, I think that the blip in oil prices at the moment was the earthquake in Turkey, which is really tragic, in Syria, and the stoppage of crude flows from Azerbaijan and from Iraq, well, northern Iraq and Kurdistan. And I think that's why the market is sort of, if you look at your headlines that you sent today, you've got two separate headlines, one talking about supply shortage fears and one talking about, about a sort of slow demand. So I think it's a sort of pretty schizophrenic market, watching what's happening on the inflation front, watching what's happening on oops, hang on, what's happened there? So I think interest rates hikes, will probably go on, maybe not at the rate that we were seeing. We're following the Fed, I suppose. The US may be on track to tame inflation, but not so much in places like the UK. But I think it's a second quarter we have to start worrying about in terms of supply. But the market is sort of so tightly balanced, or has been for quite some time, that the slightest disruption is going to move markets. And that's what we're seeing at the moment.
Peter, one of the areas that we've, this swing to Asia, this reopening of China, was also in the LNG and in the gas markets, because Europe is fairly well covered at the moment. So the swing of LNG back to Asia in January, but only with a modest increase in demand there. Where do you think the outlook for a competition for LNG goes in Asia and China in particular?
One would have thought, Sean, and I mean, that China may have stockpiled previously, and certainly their demand picture moving forward, one would think would increase, not only for LNG, but for their whole commodity swag, base metals and everything. So the overall theme is going to be, we believe, more demand from that whole zone. And the way that, as long as there's no major disruptions from supply chains and naturally from geopolitical concerns, then the overall theme moving forward is a stronger China, reasonably strong numbers coming out of Asia, and hopefully that's with 60% of the world's population, it can chug away reasonably well, and inflation doesn't rattle its cage too heavily in that zone.
You said, Peter, just to follow up on that inflation piece, that the job numbers on Friday that came out of the US, I think you captured the percentage point very, very well, 200% beyond the expectation. I mean, forecasters these days we all need to be fired, perhaps. But what does that tell you? What is that, a blip? Is it some weird sort of incarnation with misreported numbers, or is there still an inflation battle to be fought here and rates could go higher?
Well, I think so, Sean. And if I I'll answer it a couple of ways. First off, I've just been reading an article now that our governor, RBA, we've just come out with a 25 basis point hike in the last 2 hours or so. That's Australia. We're now at 3.35. Now, he has said that we will see further rate rises. Our inflation rate in the last 3 reads, if I put my memory right, was around the 6.1, then 7.4, 7.8%. So it really is a huge stretch and very aggressive rate or aggressive inflation numbers. And that sort of picture, if that is to re-engage with the sort of issues that with wartime or geopolitical concerns raising its head, and as Kate said, it's the fine line, the balancing between supply and demand. And if we were tilted and oil hit $90 or $100 a barrel, then that's really going to throw a handbrake on any chance of rates being held down, because I think that's going to be quite aggressive over the first 2 quarters to manage inflation, Sean. And answering the point, you said 518,000 for that for the non-farm payrolls. Yeah, maybe it is a blip, and it was very, very soft over the preceding 5 months from July onwards to December, and maybe it is a blip. But there are large tech layoffs. We're seeing that. Dell laid off 6,000 a day, and we all understand once they start chugging, and it's a small 5% here, and then all of a sudden we had to go a bit harder, it's another 3% or another 7% head count, then I want to see where we are by probably May, June from the head count space, and how much hurt is on Main Street.
I heard an interesting analysis on that yesterday, was that this sort of domino effect or kind of sheep herd move where they're all doing it at the same time, and it sort of has a domino effect because it gives them cover from Wall Street not to be downgraded in any way or being an outlier because they're all doing it at the same time. And how many others get sucked into that vortex will be interesting. Omar, I wanted just to talk a little bit. You mentioned the geopolitical factor there of the possible escalation of the conflict in, obviously in Ukraine. There is a big expectation with the ramp up of, it seems on both sides, as you said, a lot of military hardware coming in from Europe and America, as well as the Russians. But here in our region, we've talked before about the potential for Iran to emerge as a potential conflict space. You have always downplayed the consequence of the nuclear capability of Iran being a destabilizing factor in the region or even a trigger for war. But I was reading a very interesting insight, and a lady I've read for many, many years, Regina Durgam, founder and executive chairman at the Beirut Institute, and she makes some pretty scary reading in her post on LinkedIn over the weekend about the Israel-Iran face-off that could, and she sees as could be quite imminent.
Yeah, I mean, as we mentioned, as you say in previous sessions, I think that so I think that, to clarify, I think that whether or not Iran has nuclear weapons in a vacuum isn't such an issue. But I think that the clearly escalating Israeli response to that potential threat is major. Now, I think that Israeli escalation to Iran is not a rational response by Israel for two reasons. It's partially domestic politics. Everybody wants to get brownie points for looking like you're tough on Iran at the moment, and it's partially just plain old miscalculation stemming from having such a chronic security outlook on all their foreign policies. So ingrained in their thinking, it's hard for them to consider alternatives. But notwithstanding what I regard as irrational escalation from Israel, the reality is, I think you can see it, these steps we've been going through over the last 3, 4, 5 years when it came to initiating attacks in Syria on the military hardware. And now we've reached a stage where we're assassinating people in Iran and now even attacking Iran with drones and so on and so forth. And what's going to make the situation even more complicated is that as the Ukraine crisis continues to escalate, its relationship with Russia is put in a tough situation because at the moment it's being allowed to fly through Syria through coordination with Russia and not have its jets shot down. But if it's put under pressure by the Europeans and America in particular to take a position against Russia in the Ukraine-Russia conflict, then Russia could respond by closing Syrian airspace, or at least making Syrian airspace a lot more hazardous for Israel than it is at the moment. So the constellations have become very complicated. This is very Europe World War I, pre-World War I, in the run-up to World War I, unfortunately, with all these sort of thin alliances and flimsy alliances, and it's a tinderbox, and it could just be that the Iran nuclear deal, whether it succeeds or fails, is the straw that breaks the camel's back. But regardless of that, there's plenty of pressure building up in the background, and there's plenty of military and foreign policy incoherence by many of the key actors, and the stage is set for a major escalation, unfortunately for us who live in this region. Unlike Peter.
Kate, I'd welcome your thoughts on this point as well, if you have. I mean, Ragida is making the argument that she is seeing the potential that Iran could take a preemptive strike against Israel rather than wait for what might be the inevitable, given the threat that Netanyahu has clearly stated on many occasions, as is the American government, that they wouldn't tolerate a nuclear Iran, and that Iran's leadership may be now increasingly caught in a corner, and so have nothing to lose really about this sort of survivalist approach. That's the sort of thesis of her article on LinkedIn. Your thoughts?
I don't think they're suicidal, frankly. I mean, I think if, it's like you wake up a nuclear giant. You attack Israel or you attack its interests or the US. I don't think they're that suicidal. I think it's all idle threats. It's all talk. But we also have to look at the other tension points. You've got, we talk about China demand, but there's still an issue with the housing market in China. The economy is not, it may grow more than other, big economies, but it's still quite fragile. You've got India now protests in the streets over this whole Adani business. You've got the tensions over Taiwan. Let's not forget the balloon. I mean, there's a spy balloon over Latin America at the moment, having been, it is escalating. You've got so many issues that could just pop up.
The extraordinary thing about that balloon story, which I haven't even mentioned, is apparently the piece of kit that was on it was the size of 2 buses. I mean, geez.
Yes.
That's phenomenal to think of, the scale of this thing. I mean, I thought you could do things with a telephone these days, but 2 buses, my God, what were they sucking up in that?
I know, and exactly, and I mean, having to shoot it down in a place that wouldn't really, cause any damage, it's like crazy. But I think, there is both, supply side dynamics at play and demand side dynamics, because we can't take it for granted that Chinese demand is going to stay strong. But of course, come the winter, then we're going to maybe see a gas crunch, because there's no way that Europe is going to be able to make up for Russian gas, which is going to go down to maybe 0 even. And there's just not enough LNG in the world to sort of make up for that. So I think you might see, again, prices of LNG going up, more fuel switching, in which case there's going to be more demand for crude oil. And yes, in a way, the Saudi oil minister and the Emirates and the Gulf Arab states said, hey, listen, we cut our quotas by 2 million. What happened? Prices didn't go up. We didn't have this spike. So I think the fundamentals are more balanced at the moment than they were before. But, remains to be seen what happens, because the slightest, and don't forget, we've got a major oil field in Norway that's offline. So, these little things, any outage is going to have an impact on a pretty nervous, edgy market.
Well, it's like Omar said there. Listen to what Prince Abdulaziz was putting concern about. This is maybe a supply concern market rather than a demand resurging, when you think of the likelihood of some disruption out of Russia and elsewhere. Let's get the survey question in this morning. Saudi Arabia raises prices for its flagship crude for Asian buyers for the first time in 6 months. Why? Because 1, it sees shortages coming, or 2, again, it's the supply demand. China reopening demand is coming quicker than expected. Or 3, peak rates, peak inflation, and global growth is recovering. So number 3, but see shortages, 2, reopening, 3, peak. Peter, you mentioned in your earlier comment the reference to the dollar. We've seen dollars decline, sort of stall in the last, since the sort of bumper jobs number on Friday. I mean, it was a strange counterintuitive moment where the biggest job numbers and the markets seem to dislike it a lot. It comes to the same question, peak dollar and peak rates, or is there still some life in that old dog yet, so to speak?
Well, Sean, we've got a 103.50, and when you're thinking about, put your mind back to October, we're 114. So we've had a huge washout, or it might have been 112, but we've had a huge washout over the last 3 to 4 months, and it bounces, and it, like any market, was probably overbought. Now it became oversold at 101.50, that US dollar index, and I just needed, I think, a storyline to drive it and to get some momentum into it. We had gold move up the best part of nearly $300. So all in all, you've seen big washouts, and I think probably some of it is very much trade driven, in the sense of, paper markets and large positioning to really move against other currencies and other commodities or stock indexes, and certainly hedging and margin calls. So at the present time, I won't be surprised to take a 104, but it's incredibly volatile, where you can see the best part of a 1.5% swing in a 24-hour window. And that's, brave for traders to hang on and realize, what's ahead of them, because it's a volatile time, to put it mildly.
Omar, the question as to where or how aggressive or not the OPEC and OPEC Plus will look to defend oil prices or balance the market, as another way of saying it. That there was a sense that 90 really was the floor last year. Do you think there would be acceptance within the group for 80 as a floor this year, and that that might be the line? We saw, as I said, over the weekend, the Saudi oil minister started to talk a little bit, and other things. But do you sense that where OPEC Plus might want to position the market this year? They met last week, no change. The comments with the Saudi minister over the weekend. Where do you see their strategy for the year ahead and the price that they may be willing or able to try and defend?
So I think that compared to last year, they're realistic about, they're going to play the long game. That means being realistic about the current state of monetary policy in the US and Western Europe and other key countries. With the Fed has gone off the deep end when it comes to raising interest rates. And there's no point in trying to defend $90, which was conceived of in a world where the Fed was, zero interest rates, and then trying to transplant that to a world where the Fed is just, pressing the rate hike button continuously. So I think what they're going to do is, $80, as you say. Their goal is micro stability. So you're having a gentle decrease in price, stay at a lower price for a while. And then once the Fed has recovered its credibility as a, enforcer of low inflation, and, which probably will happen sometime towards the end of 2023, and inflation, there's a lid on inflation, then you can start to see, interest rates being decreased. And then with that, you will see OPEC responding rationally by raising their price floors. And of course, at the same time, they've got half an eye on Russia and Ukraine, half an eye on China. I think the point that Kate made were absolutely right about the property market in China being a mess, and there's all sorts of potential threats and weaknesses there. But ultimately, OPEC is in it with a much longer horizon than most commentators on the issue, whether that be they journalists or statespeople, have. And so they see things further 4 or 5 years down the line. And in that sense, it's absolutely the right call to tolerate a lower floor this year than they would have last year.
And Kate, just to give you the last word this morning with the survey result, sees shortages coming versus China reopening. I suppose they're both half of the same coin in some regards. But Kate, the idea that OPEC Plus just doesn't want to be part of the story this year. The meeting last week was a quick and silent one. I'm not sure if there was even a press release. I presume there was, but nonetheless, brief, that they do not want to be a part of the to be sucked into the geopolitical vortex that was defined last year. And so, unless there's really a big moment to intervene, they're going to stay on the sidelines. Your thoughts on that thesis?
Yes, because I think what they did last year when they made that announcement, they wanted to make a big splash. It was a message to Washington. It was basically, we're going to cut our production quotas by 2 million, whether you like it or not. We're not going to be dictated to. That's why they had an in-person meeting. It was more a political message, even if the economics of it, the fundamentals, were actually quite sound. So I think that's why they will now, yes, having done their bit, they've shown that they are not going to be swayed by the big powers telling them what to do, by the IEA, by Washington, by the EU. And now I think it's sort of steady as it goes, and we will respond if necessary. But at the moment, you've got our guidance from now until the end of the year. These are the quotas. And of course, there's going to be issues with Nigeria. There's going to be issues with Libya. They might need to tweak it a little bit, but I think that's the course we're on. And I don't think they're going to deviate from it unless something really major happens.
Well, we'll wrap it up there with oil prices, as we said at the top, Brent trading at just shy of $82 a barrel. a significant enough recovery from under 80 on Friday. And also to note, we have launched this morning our annual year ahead energy outlook report, which was harvested from the big bonanza around the world we did a few weeks ago, with including the three of you guys featuring in the report from your comments on the Outlook forum we did on mid-January. So please take a chance to have a look at that and share it with all of your network. Thank you, Peter McGuire, as always, from Australia, Omar Ubaidli from Bahrain, and Kate Durian now in Dubai. We say woo woo to that. And thank you. Have a great day, everybody. All the best.
Thank you,
Thanks,
Sean.
Sean.
Cheers, Kate. Bye, Emma. Thank you.
Bye, everybody.